All right, I think we're live.
Okay, welcome everyone back to the Beat the Odds podcast. Today we're going to talk about Canadian inflation.
Ooh, that sounds like a
Canadian
fun topic.
inflation. So, I've got my trusty. One of my clients gave this to me. It's 20 billion Zimbabwe dollars.
Dude, you're a billionaire.
20 billion. This is like my favorite present someone has ever brought me for as long as I've been working here. 20 billion, and it's worth the least. It's
Right.
worth, I couldn't even buy one of those box of chocolates, right? But it's worth the least, right? And the joke I started to say to people, they think inflation's bad. It's like they haven't even started adding zeros to the currency yet.
Oh, man.
We're getting a little feedback there, Trevor. I don't know if you want to. Oh, that's on me. Oh, it's on me. It's me.
Mute.
Here we go. Bang. Okay.
There we go.
Yeah. I mean, for the trouble that we're having, like, we haven't even started adding zeros to the currency yet, right?
Yeah, I mean,
So
that's the thing. You can keep adding zeros and zeros and zeros, but, what you can buy with those zeros kind of goes down, which we're going to talk about today, probably with the CPI and all of that stuff. So,
yeah.
And what's the other thing you got in your hand there?
I mean, the other thing is an ounce of real money,
Oh,
gold. It's the properties of money. It's a unit of account, median exchange, store of value. A lot of people don't know that the Canadian Mint makes gold that is legal tender. You could actually use it for $50. I don't know why anyone would ever use it for $50 because it's worth more.
Right.
The gold is worth more than the legal tender value. So, but I always keep this here on the desk for when I'm doing client meetings because this is the goal. This is the main goal, and we get lost in the headlines, and we don't understand what's happening, right? I mean, we're going to talk about Canadian inflation here, but did you see the debate last night?
I totally was not even interested. I knew it was going to be a complete, crap show. What I posted on Twitter was like, you know what? I'll just catch the highlight reels from everybody that's going to be posting it tomorrow because I can't waste my time doing that.
I mean, yeah. Here's the takeaway that almost no one will give you from it, right? They're all gonna talk about how many times they fact check Trump and how many times they fact check Biden and all Biden's missteps. And it was interesting that the Democrat supporters on CNN turned on him after the debate and started talking about replacement and everyone kind of maybe foresaw that at least being a possibility, right? But that's not the main takeaway. That's not. Everyone is going to get distracted and they're going to get lost in that. And the main takeaway has to be. Let's get this U.S. debt clock. Let's pull this guy.
Oh yeah, actually, I watched an interview between Thomas Massey and Tucker Carlson, and Thomas Massey, he wears a pin on his jacket at all time, and it's the debt clock.
Yeah. I mean, here it is. They're closing in on $35 trillion in debt. Oh. And you know the takeaway from that debate last night? Neither of them has no plan.
No.
They got no plan on $35 trillion, right?
Well, honestly, like what could the plan be? I guess they could come up with something, like anything, but there's no real good way to tackle $35 trillion of debt. And it seems like there's no end in sight as far as how much they're willing to spend.
There is only one mathematical way that's actually plausible. They have to inflate their way out of the debt. That's it. There is no way for them to remove 7%, like a 7% deficit on GDP. Like 7%. It's like you can't cut that out without causing a depression-like event, right? And so that's the takeaway. You're going to see, clips and sound bites. And no one's going to talk about that. Neither of these guys had no plan for $35 trillion in debt. It's just 35 trilly, as I like to call it.
Yeah, that's all. Yeah.
Just call it. It's just a trilly now, right?
Just a trilly.
It's just a trilly, right?
My goodness.
And so when when we're looking at this, we'll get right into the Canadian numbers here. So I posted this. This is our CPI. If you can put that one up on the screen there, Trevor.
Yeah, it's
June 25th. We had that guy.
Yeah,
2.9%. 2.9%.
Wow.
So Bank of Canada range between 1 and 3%. So we did have an increase from 2.7 to 2.9. And we talked about the interest rate update last time. It's like, is it a politically motivated decision? It's like, would I have cut the interest rates? No. I mean, as an investor, am I happy that they cut the interest rate? Yeah, but I mean, would I have cut? No, I just don't think there was enough pain in the economy for all the doomsayers of the people following the condo market in the Greater Toronto area. It's like we're not anywhere close to historic bankruptcy levels. There's not enough pain in the economy to justify that. This risk here, like this is the risk, right?
Yeah,
this is the one.
Exchanging the fake
right?
money for the real asset.
I mean, this is the one, right? The line I heard, someone say on Twitter is it's like we started with 2 weeks to flatten the curve, and he was in the supermarket and he had a veggie tray, and it's like we started with 2 weeks to flatten the curve, and we ended up with $87 veggie trays.
Yeah,
like that's where this thing has gone, right?
Yeah.
And so we see the CPI reporting schedule at 2.9%. It's like, do I think they'll get their fake CPI number back down to 2% to restore confidence? And I tell people that it's the fake CPI number, and a lot of the people drinking the government Kool-Aid is they want to say that is the real rate of return. It's like, good luck trying to buy a house. If if you're saving for your down payment in your house and you're making 2% on your investment account, it's like, good luck catching that, right?
Yeah.
The government CPI number is not going to keep pace with any desirable asset class. And that's when we posted every single month. I posted every single month of what the median wages are in Canada and compare them to desirable asset classes. And it doesn't matter. That's median wage. We could be looking at minimum wage, or we could be looking at top 1% wage. It just doesn't matter. Your wages won't keep pace with desirable assets.
That's right.
The entire game here is, you see this 2.9%, and it crept up. It's still within the band. Okay, so on one hand, it's still within the band. Do I think they should they cut at the next meeting? Should the Bank of Canada cut again another quarter point to the next meeting? It's like, well, I mean, if you ask me, I'm not quite sure why they cut at the first meeting.
Right. Yeah, they should have just held on.
I understand people will always look short term, and most people will look short term, and the popular decision is to cut. But long term, it's like, I have kids, right? And I know our parents bought houses with 6 years of median income, and people today, Gen Xers, millennials, and Gen Z are trying to buy houses with 20 years of median income. And I know our kids are going to have to try to buy houses with 40 years of median income. And so, when I look at that, when I look further down the path, am I willing to live with a prime rate of 7.2% for a little longer? Yeah, I am. Do I understand that most people want it cut right away? Yeah, I totally get it, but most people are broke. I mean, most people are wrong about most things most of the time.
Yeah, true story.
And usually it's because, they took a short-term view in life, right? Mm-hmm. If you want to have any success in life, you're going to have to take a longer-term view. So, but ultimately, we know that inflation is still a risk here. Like, this is still a big risk. Like, we're not out of the woods yet, right?
No, for sure. And we don't know what's coming down the pipe. I mean, it's an election year in the United States, and then the following year is the election year for us, for Canada. And there's still a lot of time for the monkeys to get into the works and, really turn things upside down, right? We are governed by some of the most unimpressive people in history. Like, they're just not qualified to do the job. And if you talk with like Kevin O'Leary, he's more than happy to say, yes, no offense, but they don't know what they're doing. They're the worst. We have the most resources. We could be the wealthiest nation, one of the wealthiest nations on earth. led by idiots.
It was a good interview. I saw it.
Yeah,
Like, it
so
was a good
good.
interview. He really hammered them. But I mean, just look at that. That is the number one risk facing people. But they're going to distract you with every other issue under the sun.
Yeah, weather balloon. Right.
And sometimes, like, some of the fears, like, they're going to scare you about the housing market. They're going to scare you about the stock market. And they're going to say, it's like, wow, treasuries right now, you can get 5% in treasuries. It's like, the real rate of inflation, if you just bought lumps of gold, you have a compound annual growth rate of 8%. 8.3% in Canadian dollars over the last 25 years. 8.3%. So this is the real rate of inflation. This is our baseline. If I'm not making more than 8%, I am moving backwards, okay? So if I invest in treasuries, it's like, am I sure I can time the market? Am I absolutely sure I can time the market? For those of you who think you can time the market, like, again, where is your private jet? Where's your private jet and your island?
Didn't they do an experiment where a monkey picked some stock picks and he like did as well as like a stockbroker, an educated stockbroker? I thought there was an experiment done back in the day with that. So basically, there's no way you can time the market. You can't pick and choose and guess what's happening.
I mean, and mathematically, the more and more things that you choose, the less likely you are to beat the market, right? Really, when you start getting up around 20, 30, 40 shares, like if you're picking 20, 30, 40 shares, it's like you're not actually going to beat the market. I mean, that's just the kind of a mathematical certainty.
Yeah.
And you look at today's mutual funds and they're holding 50, 60 shares. It's like they're guaranteeing themselves the average rate. And so all you look for is, you know, when we look for investments, it's like we know what the market rate is. We look for the segments of the market, the types of corporate structures of the market that historically outperformed over time. And then again, what's the tax rate? That's what people don't understand. It's like, I can have a U.S. dividend that pays X and a Canadian dividend that pays Y, but what do I get to keep of that after tax? And what's that investment structure? Is this a constantly revolving door that I'm triggering capital gains all the time? Or is this a buy and hold structure that I can, basically defer the capital gains tax to infinity? And so, like, we look at that, but this here is like, it shows us we are not out of the woods yet, right? And I've talked with you before, we had a discussion last week. It's like, what's my number one concern? My number one concern in Canada is that Trudeau goes full universal basic income on his last budget to save his ass. Like, that's my number one concern, right?
Yeah. At the same time, he'll have to put in a CBDC in order to make that work.
I don't think
possibly.
I don't think they would. I think they proved it with. I mean, I think a lot of people want. there's a lot of people who want the CBDC, but I think they proved in COVID how robust the CRA system was on rolling out CERB. Like, it worked. It really worked. It was really efficient. And kind of got to hand it to them. It's like, it was actually way more efficient than the American system of how they were getting their stimulus checks. Like, just the mechanism behind it. Forget about if it was a good idea or not. Just the logistics and how it rolled out. It was like, it certainly wasn't perfect, but like it worked very well. So if they wanted to get $2,000 a month into everyone's hands right away, it's like they did it very quickly without any experience last time. They could do it much quicker this time around.
Yeah. And you want to talk about $87 veggie trays. Imagine what the veggie tray cost would be, the inflation on a veggie tray after
I know, and the concern is that people will see that universal basic income, and in reality, it's like, I hate to say this, but if they rolled that out, I think you'd see another 4 years of Justin Trudeau. That's as wild as a statement as I'm going to say. It's like, people have this, they're seeing what happened in Toronto there, where they had the one by-election, and the Liberals lost in a Liberal stronghold, and they're saying it's insurmountable odds. It's like, I'm telling you, people have like very short memories, right? And it's like, would I vote for the guys? No, you can give me a universal basic income of $10,000 a month. It's like, I think it's a terrible idea. It doesn't matter what the value is, because everything will just cost that much extra, very soon after.
Yeah, hold up that $20 billion bill there.
It's like 20 billion. It's like, you can give me more fake money. Nothing has changed. Like, nothing has changed in the economy. We're not producing any more food. We're not producing any more houses. We're not producing any more stuff.
We're actually producing less.
You're just changing the value of the currency that it's denominated in, and adding a administrative structure on the bottom end that costs money, and you're reducing the incentive to actually produce stuff, because there will people who will take themselves out of the economy and stop working if they have a basic amount. Like, we saw it. We already ran the experiment. Like, CERB and CRB, it was a universal basic income. Like, that's really what it was, right? So we already ran the experiment. It's like, what happened to the productivity? It went down dramatically. And so that would be my main worry for inflation in Canada. But it's still attached to the U.S. too, and we have to understand that they're at a 7% deficit to GDP, which is big. And then I saw a couple clips of RFK, and apparently got a whole bunch of views. And he at least talked about the issue. But his solution was, well, we're going to use AI and cryptocurrency to grow our way out of it. It's like, you're going to grow your way out of it. So that means you're going to have a compound GDP growth rate of 8% a year over year in a developed country to offset your 7% deficit. It's like, no, you're not. That's stupid. I mean, that's like saying, the Oilers are going to come back next year and they're going to run the tables and go 82-0. It's like, it's not going to happen. Like, you're just not going to grow the U.S. economy by 8% year over year for a decade to offset the 7% deficit. Like, that's not going to happen. It's like, so they're either, too stupid to realize that, or, they don't want to say that because it's not an electable position. Because the real truth is we're broke. In the Western world, we're pretty much broke. The government can't give you anything because it doesn't have any money. It's been broke for a long time.
Yeah, well, I mean, it comes back to the fundamentals, right? The government doesn't produce anything. Like, it just takes tax dollars, or it prints money to provide, free stuff. Mm-hmm. They promise free stuff and give out free stuff. It doesn't really produce anything or add into the GDP or the economy, really.
Yeah. And so I also track, this is not one of my popular posts, but we always track oil, the price of oil. Whether we like it or not, the price of oil affects, like, oil is the single biggest energy source in the world. And it's by a lot. It's not a small amount. If you look at how much energy, I don't mean electricity, people, energy. So electricity doesn't come from electricity is a secondary source, not a primary source. Something else creates electricity, whether it's natural gas or whether it's nuclear or whether it's a hydro dam. Electricity is a secondary source. It doesn't just, there's no electrical ferry that's on the other end of that plug. Oil is a primary source of energy. Natural gas is a primary source of energy. Coal is a primary source of energy. And guess what, people? Those three, they're still the top three. Oil, natural gas, coal.
Yeah.
Coal, people, is coal. I mean, and that's how the world still operates. Whether you want it to operate that way or not, that's how it operates today. And so we have to understand that every single thing that happens in the economy, it's a factor of energy. It's like, even today, me and you right here today, we can't have a podcast without energy.
Impossible.
It would not work, okay? So the world runs on energy. Every price that you pay is a factor of energy. If energy prices skyrockets, the price, what you pay for everything, also skyrockets. And it's actually quicker than monetary policy. If if the central banks raise rates, if they lower rates, that has a delayed effect. You're going to see the effect of that 6 months, 12 months, 24, 36 months later after that happening. Energy, it's a much shorter wick. Once that inventory on the shelf runs out, and people don't carry a lot of inventory these days, the prices get adjusted very quickly.
Yeah, very quickly.
The supply chains are very short. These are things that happen, you start to see the effect in 1 month, 2 months, 3 months, right? And you can see it here. Like, just look at the price of oil, where the red happens, where the price of oil is increasing, and you start to see very quickly that the inflation rates in both countries are increasing. Okay? And, we look at, look down here, price of oil starts to go up again, and all of a sudden, inflation creeps back up. And people don't actually understand how the world works. And I'm going to post this relentlessly, and I don't care if it gets one like all the time, because this is actually what I look at.
Right.
Like, everyone knows, I come into the office, people who know me, is I come into the office, and the first chart I check before I talk to another human being, it's the price of oil. I check that before everything else. It's the base layer of the economy, okay? And once you understand that the world runs on energy, then you have to understand where are our primary sources today, not where they might be 10 or 20 years from now. What is our primary source of energy today? And what's the price of that energy? Everything is going to be based off of that. It should be your foundational understanding when you're trying to understand. It's like if they could, raise rates to, we could raise rates at the central bank from 5% to 10%, okay? But if oil spikes to $200 a barrel, you still got inflation, people. That's still going to happen. It's really still going to happen.
Yeah, because it totally affects the cost of production, right? So if it costs more, then everything else down the chain is going to cost more. Just makes perfect sense,
yes.
Right? But a lot of people don't tie those two things together, especially, people complain about the price at the pumps. Well, the price of oil, like that has a major part to play in how much the price is at the pumps, and also your electricity costs, your food costs, everything. Like the price of a Big Mac is affected by the price of energy.
And I mean, once you go down the energy rabbit hole, you end up at Bitcoin. But I'll let people, they need to explore that themselves first, right?
Yeah,
they have to understand that the world works on energy. And that's what, the naysayers of Bitcoin sometimes will tell you, that it's too energy intensive. It's like, that's the point. That's a feature, not a bug. If it was easy to produce, everyone would produce it, right? So taking out the energy component, and a lot of the world's energy is stranded anyways. You can have a hydro dam, but you can't transmit the power from that hydro dam for thousands of kilometers. It just doesn't work that way, right? Mm-hmm. And so if it's not used in a close enough vicinity, it's essentially stranded. There's a lot of stranded energy that happens, and essentially when you look at it, that Bitcoin is digital energy. But so then I look at the supply of oil, and we post this all the time. We post, first of all, we just look at the month over month. What's been happening in the last 24 months on the price of oil? Okay, and you can see it's like we actually had a little bit of reprieve the last couple months. So for those of you who've been watching these charts that I post, every single month religiously for years now, it's like we actually had an increase in the millions of barrels of oil, okay? And so we went, kind of downward trajectory to 779 million barrels of oil, then up to 807, up to 815, up to 827, and for all intents and purposes, just stagnant in 2020 in May. Okay, and so having that supply of oil, it's like, because when you see the supply dwindle, you should be very concerned that the price of oil is going to spike. And if the price of oil spikes, what happens to inflation? Inflation spikes. And if inflation spikes, what happens? The interest rates? They're going to be very, very hesitant to lower them. Okay, those three things are connected: supply of oil, price of oil, inflation. 4 things: interest rates. You have to see that happening down the train. It's like that has a direct connection. It's not. It's not just interest rates. Interest rates are not the only thing that's going to affect inflation, okay? This is a month over month. And then I step back and I tell everyone, it's like, when in doubt, zoom out.
Right.
When in doubt, zoom out. Then, rather than 24 months, let's do 24 years, okay? And so we start, year over year on the same month, going from May of 2001 to May of 2024. And you can see that oil supplies were increasing in, let's call it from 2005 to, even here. We top out to 2017, okay? Almost 1.2 billion barrels of oil, okay, in supply. But then since then, we've been on a steady decline. And the reason is all the energy producers, they haven't made any capital expenditures because it's just been too risky. They're concerned, can they get a pipeline built? They're concerned they're going to hit with some pollution tax or green tax. And so they've just been running their profitable capital equipment now and very hesitant to invest in new supply because the political climate on producing oil, it's not very good. It's a big risk to the shareholders. As a shareholder in some of these companies, energy companies, I get it. It's like, just shoot me off my healthy dividend every month and shoot off your profits. Like, why are we going to take a risk, right? And the thought process is, is that alternative forms of energy will replace the declining supply of oil. But that in itself is like, that's brought to you by the same politicians who have no plan for $38 trillion in debt. It's like they just have no plan. It's like we have a bunch of clients who are electricians. And if everyone buys an EV car on the block, and then they all want to upgrade. They want to get an EV charger, and then they're going to find out, hey, wait, I don't just need an EV charger. I need 200 amp service to my house to get it. And when you start to look at, if you upgraded every house on the block to 200 amps, it's like, it's not going to work on the existing infrastructure. It's like there's not enough juice on the grid for that to happen. And so, do I have confidence that they're going to be able to dovetail that? No. Like, would I bet my family's wealth on that? It's like, no. I have to bet the safe bet is to know that spikes in energy prices are not just possible, they're actually probable in the course that we're on, right? And you start to see how these things are wound together. It's like, although we've had a little bit of reprieve here, this is okay. This is a little bit of a source saying, okay, we haven't just started depleting. And we have to understand that 826 million barrels of oil today is more tenuous than 844 million barrels here because we use way more oil than we used 24 years ago.
Oh, yeah, 100%.
A lot more oil than was used 24 years ago, right? And you're starting to see the kind of the chinks in the armor. And when I come into the office every day, it's like I look at the price of oil. I look at the S&P 500. And those of you who been to our boot camp and understand our investment strategies, I don't actually own a lot of S&P 500 stocks. It's like I don't own any actually, because of the tax inefficiencies there. But I look at it because I understand it's the world's capital market, and then I look at the U.S. long-term bonds. Okay, so you can look at TLT and look at the U.S. long-term bonds, and they've taken an absolute beating because people start to understand that these things, and the market understands that these things, with greater and greater conviction, people know that these things are not going to keep up with inflation. Okay.
Yeah.
And that's why they got absolutely hammered more than they have been in 100 years. Okay. And which foreign country owns the most U.S. treasuries? Japan owns the most U.S. treasuries. And so, the canary in the coal mine that I always look at every day is we look at the U.S. dollar to the Japanese yen. Okay. You want to know where inflation is. You want to understand how all these pieces fit together. It's like, Japan has $1.2 trillion of U.S. treasuries, and Japan has no energy to speak of. Like, they really don't. They have to import their oil and gas. They have to import the uranium that their nuclear power plants run on. It's like they can't produce it themselves. And we're looking here. Look at that chart.
Wow.
That should scare the bejeebers out of everyone, okay? Forget about, oh, you can't move your condo in Toronto today because the prices have been, the prices, we have a little bit more inventory than we've had in the last 24 months. It's like, one of the largest currencies in the world is blowing up in real time. And this country owns, is the biggest foreign holder of U.S. treasuries. And if their currency becomes more and more devalued, they have to dump the U.S. treasuries to prop up their currency because they have to buy energy. They're not going to function in the dark.
No, they can't.
And these things are put together. So when we're looking at that, where is inflation going? These are the things that we need to understand, right? And ultimately, we'll put the CPI number here. I'm happy that they're in that 1 to 3% band, but I don't have a lot of confidence in it, right? I think they're going to normalize it to the 2%, but it's like I don't think people understand how close we were to the brink. These things happen in cycles, and so the logical conclusion here is that they're going to normalize at 2%, according to the government CPI number. But we have to understand, it's like the real inflation's 8. People, it's like the real inflation of desirable assets is 8. Study desirable assets. Use gold as a quick and dirty test of what the actual inflation is. And that will help you make better long-term decisions for you and your family to build wealth.
Awesome. Well, I think that's all the time we have for today. Thank you so much for joining us if you're with us live. And we'll be back next week, but you're going to be somewhere special. You're going to be in Dubai, and we're going to try and do this over Zoom.
Over Zoom, right on.
Oh my gosh. Okay, see you guys next time.